Welcome to another episode of the Lightspeed Investing Podcast. I'm so glad to have Miss Nicole back here again from Mag Capital. She is here to talk to us the specifics of her industry and how Mag Capital differs from everyone else. Nicole, how are you doing today?
I'm doing good, Philip. Thanks for having me back.
Of
Glad to
course.
see you again and happy to dive into the topic. Yeah, commercial real estate is definitely um, it's an alternative investment for most and not typically people's something that folks just kind of jump into, right? So unlike traditional residential real estate where everyone needs a home, not everyone's going to buy a building or a warehouse in their time, right? So it's new for most people, and I'm happy to be here and talk about it.
Yeah, so I guess what are for let's just I assume the audience knows nothing, right? So for those who are brand new listening in, what are the advantages? What are the pros and cons of commercial real estate compared to the traditional residential real estate?
Well, for one, similar to residential, right? You have stable, predictable cash flow. So commercial real estate often has residential or has rental income just like residential does. And typically this is similar to your residential. However, you have you can look at the tenant's financials. So where in residential you don't do that, or maybe you kind of take a look at their credit. Um, this may be a little different, and based on their financials, you can kind of you can decide where their rate is. So if you have, a tenant who's cash flowing very well, you can make more on the rent. And then you also have things like tax advantages, right? So in commercial real estate, you have things like depreciation. You can 1031 exchange. I guess you could do that in residential as well. Um, there's opportunity zone incentives. So if you see a zone where there's like a factory coming in, that might be a really great place to go and look at real estate. And capital gains is treated different. So there's a few differences I would say in terms of what makes it different than residential, but overall I would say the main difference that between a real estate investment versus a regular investment or maybe like day trading is that you have a tangible income producing asset.
Now, most people when they talk about commercial real estate, they tend to think maybe multifamily, right? And the advantage there is like, oh, you have multiple doors, as opposed to like residential investments, right? It's one single door. So if you're not talking about, say, apartments where people can live in, right? Like, what are the things that you're looking for that can make it a worthwhile investment?
Well, sure. So one of the things you mentioned, multifamily. Multifamily is always great. In a lot of ways, these asset classes are cyclical, and so just as you have areas where, now Phoenix, for example, that's where I'm at in Scottsdale, has been an area in the last 10 years has been growing exponentially. Just like you have little bursts of that, and we meet that with development. Now we have overdevelopment where the statistics are showing we have more development here in Scottsdale than folks actually coming in or being here. So more apartments and houses than people. Um, like everything is cyclical, right? So if you're looking at macro or global economics, what you're seeing is we're having onshoring of US manufacturing, which has been really good for industrial, which is the asset class that I'm in. And if you look at industrial vacancy rates as a whole, we have a sub 5% vacancy rate. Now, the reason that's important is that's something you want to be looking at when getting into a commercial real estate investment is what are the vacancy rates? Because if you have if you have vacant real estate, although you still have the value of the real estate, the tenant gives it a lot of value because you get that cash flow from the tenant, right? So when the tenant is paying rent, that's where you're getting paid. And then when you sell the property, of course, then you get another profit share. But you want to make sure that when you sign in with a tenant that they're going to be there for a long time, hopefully, and they're stable.
And but the thing is, for clarity purposes, right? Like in your case, you guys specifically focus in on food manufacturing, which is
Mhm.
great because it's essential goods. So in that case, like who are your tenants then?
Yeah, so that is one of our focus. So we like to focus on US manufacturing and food produce. And so we have a handful of tenants nationwide, and they do things like they have things like potatoes, onions, green beans. Jolly Green Giants is a good example of one of our tenants. So
Okay.
these are folks that have a high renewal probability, although it depends on what your strategy is. So our strategy is we're coming in with a 20-year absolute triple net lease, which means that the tenant takes care of all of the expenses.
Mhm.
Um, for those who don't know, absolute triple net is something to definitely look for because it keeps the expenses out of the syndicator or the LP's hand. LP meaning the limited partner, or you if you're coming in on an investment with a syndicator like Mag Capital. And they're if they, 20 years is a long-term lease, and we'll hold for about 5 years of that and then sell that contract off. We'll either package it up and sell it institutionally or do one-offs.
Okay. So in this case, then, how many tenants are you bringing in per acquisition? Is it like for each commercial real estate, you need five? Like, how does that work?
Yeah, so it depends. An example would be like we're on our third fund, and we just closed on Robin Sports. That was one of the first acquisitions in the fund. I believe we had 6 buildings in that acquisition. So they manufacture wood floors. They manufacture floors for the NBA, NCAA,
Okay.
and organizations likewise. They have patents on their floors, and they've been around for over 100 years. And so you have a very stable tenant there. Our goal in finding these types of properties is A, we're going to have a tenant who's not going to leave, and you know, B, like in this case, we got a lot of real estate out of the acquisition, which is great. Um, and to answer your question, it can differ. Um, but that is also an example to the prior, an example for the prior question of what our tenants can look like, either food produce or manufacturing.
And they're more so, it sounds like they're business owners. They're not like in multifamily apartments or tenants or people looking to just have a home, right? So
Yeah.
here, these are people looking to have a home, but like a home for their businesses. Is that
Mhm.
where, so
Yeah.
they're mainly business owners and they're your tenants.
Yeah, that's right, Philip. So,
Mm,
essentially, this is where they manufacture all their parts, all their floors,
there
in
you
this example, and they're not going to get up and move. So imagine a situation where, they're having financial struggles. They're likely to reposition either their debt or move some things around before getting up and moving from, their seat of how they're making their money, right?
Well,
So
that's actually a great point. So in that case, why are they open to having a conversation with you if assuming, right, they already are operating elsewhere and you're saying, hey, like I have this other space, maybe you should do your business out of, right? How's that
yeah.
conversation look like?
So a lot of these factories, for one, they have a lot of employees, and they're not looking to lay everyone off and move and then try again, and they can't really do remote, right? So when you hear about folks like Amazon moving their headquarters out of Seattle, well, that's pretty easy because a lot of these people are doing tech jobs. They can go remote. They can either move if they have a high enough position where it makes sense. But for the most part, while COVID was happening, Amazon is an example of an organization where the employees are just able to go home and work remotely. Whereas in US manufacturing, you don't necessarily have that because it's essential to the supply chain, right? So you have a vast supply chain, and it's there that property is an essential piece of it,
Mhm.
because they're manufacturing, they're distributing. They're and they can't get up and just move. I mean, I guess they potentially could, but it comes with a lot of headache behind it. And you have to find all new staff, employees, you have to move everyone in the company. And a lot of times it's where they've been for the last 100 years, that's or 50 years or even 20 years is a long time to get up and move all of your equipment, um, and find another space that's relative in the same structure is not very easy.
No, for sure. So I guess my question was if that's the case and they are already established in another facility, right? Like how are you able to appeal them to maybe look at investing and moving over to what you guys are newly investing into?
Yeah, so that's a good question. We're not having them move into our properties. We're actually coming in and buying their real estate.
Oh,
So
I see.
yeah. Yeah. So this is called a sale leaseback, this structure. And a lot of folks use it. Some people do developments. We personally are mainly doing sale leaseback as a strategy in acquiring real estate. And that's because we have a guaranteed tenant. We're not buying real estate in hopes that a tenant is going to move over. We're buying real estate that is already occupied.
Ah, okay. That. There you go. There was the
Yeah.
yeah.
That's where we weren't meeting. Yeah.
Yeah, yeah, it's okay. No, but that makes way more sense. So then, okay, so then the question is, how do you, I would say, assess the property or assess the territory, the region to go, okay, under these criterias that we have, this makes a worthwhile conversation and and we should look into acquiring this specific property. Like, what are the metrics that you're looking for?
Sure, we have an acquisitions team that takes a lot into account, including, sub-market data. Things like we're looking at replacement costs, we're looking at the market price. We want to get, below market price, below replacement cost. We want a piece of real estate that's very competitive in pricing in terms of if we were to lose the tenant. Say we do a sale lease back and within 3 years, the tenant, something does happen and they do leave, we'll have to put the real estate back on the market and try to find a new tenant or sell the real estate, right? Because we want to return money to investors. And so if we're going to replace the tenant, we want to make sure it's competitive. We want to make sure that they'll be able to pay rent and be happy with the rent so that we can quickly execute a new contract with a new tenant.
So I
Another
guess what regions do you mainly have your investments in right now? Because I believe talking to your executive team, you guys are mainly headquarters in Dallas, LA, and the Phoenix area, right? So do you go broader than that when you are looking at acquiring real estate, or do you mainly stay with between like the Midwest and the West Coast?
So in terms of our real estate's mostly based in the Midwest and we're location agnostic, right? So if you were to just look at a map, yes, we have a higher concentration in the Midwest. We don't do that on purpose. We're not looking there on purpose. We just tend to see a lot of great opportunity there for our thresholds, right? In terms of our team, well, we're also agnostic, but we have most of our back office and operation side in Dallas, including one of the partners and another partner in the San Fran area. And us on the investor relations team, we're kind of scattered all over the map, but
I
all US based.
And so for you, it's all US based spread across. Um, what are the threshold for your investors, right? Like that usually is a no-brainer, right? Like what do they tend to look for, right, when they invest into your projects?
A lot of things. So first and foremost, I would say this is something that we see a lot for folks who want to retire, right? So you have people who have their 401ks, they have their IRAs, and they're looking for investment. We do accept those types of investments. The beauty is we can accept individuals, corporations, LLCs, retirement accounts, you name it. Besides the traditional 1031, which we do get questions on, we accept most entities, and typically they're looking for something that is stable, is going to pay them a nice yield because most of these folks are looking at something traditional and low yield like a bond. Um, And, so there's that. There's tax advantages. So if you're looking for depreciation, which means you get net losses, if you're looking for a deduction on qualified business income, commercial real estate is one of the only asset classes that can give people that type of tax break. So we get a lot of people for that. And some people really like commercial real estate. They think they believe in it. If we have people who reach out because they think that, with the onshoring, they see a really great future for
Mhm.
industrial. They think that if the market crashes and everything goes down, then, one of our last bases will be US manufacturing because it's an essential good,
Mhm.
food produce because it's essential good. And so we have people like that too, who are just very optimistic about the direction that we're headed.
Absolutely. And how long have has your space been around, would you say, like investing into commercial real estate for food for US manufacturing and food or produce?
Well, for probably since the beginning of the United States, let's say probably if I had to, guess, people have been farming for a very, very long time. That's how we all get fed. And in terms of this as an investment strategy, well, um, I believe it's been a long time. Getting this niche um, it's starting to become more popular
Mhm.
nowadays. We kind of started before it was super popular, we like to say, but it's a very small space, and all of our competitors are institutions. So we're, even at 1.3 billion AUM, we're a smaller shop compared to a lot of folks,
Mm.
but we are very competitive. We're very quickly executing, and so we get some deals that they don't. And so that's one of the advantages of, being a little smaller and being able to make decisions
What
faster.
what is the average AUM in your space then, if according to what you're saying right now?
Well, it depends if they are invested in solely industrial versus an array. We have a lot of competitors who do more than just industrial real estate, and they could be 10 billion, 100 billion.
Gotcha.
And but typically we're people aren't so they're not so niche, right? So we're
Mm.
incredibly niche in what we
I
practice.
see. Oh, okay. And
And
in regards
a lot of
to
people diversify their app portfolio when it comes to commercial and their funds,
uh
where we like to be very focused in this space.
Oh, gotcha. So you're specifically focused on what then, like what makes you guys I would say mainly different in terms of your area of expertise.
Well, I would say, for one, we have an incredible track record. So we've had over 120 acquisitions, and of that, we have under a 0.2% default rate. And all that really means is that we've had one tenant default after all of those acquisitions, which is incredibly low in comparison. And even with that default, we were able to return investors 11% IRR, which is a yearly return overall, correct? So, um, and that is a really nice return for a tax advantaged a real estate deal in this space.
Mm. So you're looking at 11% annual. What's your distribution? Is it quarterly or monthly?
Yeah.
Or-
So 11% annual, that was our default. So overall, average annualized average annualized rate of return is 17.5%.
17 and a half.
Yeah, and we do quarterly distributions, we do monthly,
Oh, I see.
depending on the deal.
So what is the minimum buy-in? What's the barrier to entry?
So it depends on the deal as well, but for this fund that we're raising on, it's 75,000.
Okay, 75. What's the time frame or runway for you to see an ROI? Like if I put in 75K or someone puts in 75K right now, do you start distributing that quarterly, like as soon as this first year, or do you have some ramp up to it, because you have to let the deal close and things like that?
No, you start getting distributions right away. So
Oh wow.
distributions accrue from day one. And a
Okay.
lot of this has to do with our fixed expenses. When you have fixed expenses on triple net, meaning tenant takes care of all the expenses.
Oh.
You have fixed expenses on the debt. You can kind of get cash flow from day one and just start distributing that to LPs without having to cover any losses.
And is so the 17.5, do you guys call that a fixed rate of return, or is it a more variable rate of return where it kind of fluctuates? Like
It's definitely variable.
it's
Um,
variable. Okay. So what's the
and
range then if it's variable?
I would say 15 plus.
15 plus. What's the highest you've gotten your investors?
Well, probably mid 20s, closer to the mid 20s.
Okay.
Um, I
What are the things that affect this variability then?
there's a lot of things that can affect the variability. Some can be rates, like general, Fed rates. Some can be when we decide to exit real estate.
Hmm.
Um, sometimes a tenant does really well or maybe there's an expansion and the real estate is worth more because we've added on to the property.
Oh,
So
I see.
there could be a lot more things too.
So would you say of if you had to like pie chart the total of your 120 acquisitions, how would you pie chart the specific niche, right? Because you said you guys are, that's one of the things that separates and differentiates you, right? Is you guys are very focused.
How would I pie chart
Yeah,
the
like 50% is in food manufacturing or food program,
oh
that kind of, yeah.
yeah, it's tough to say the specific advantages or specific percentages, but I would say that there's probably more in manufacturing.
Hmm.
Um, although the food produce are really great deals, we've had a lot of manufacturing tenants in the past.
When you say manufacturing, you just gave me an example of hardwood floors, right? Like earlier at the beginning of the episode. What other manufacturing, outside of flooring, do you guys go and do business with?
Yeah, well, we would really take anyone that is uh, a crucial industry, right? So we'd like to avoid folks that are like printing,
Okay.
um, anyone who might go out of business. And
Who might not be as prone to surviving in this current digital age, right? You're looking for industry, commercial real estate that will still thrive because of the inherent need of the American economy, right?
that's correct.
Okay, gotcha. So that could be anything from flooring to,
Yeah, that could be from flooring, that could be from doors, and that could be from, like things like pipes.
oh wow,
Um,
okay.
things that you just don't really think about.
I know. That's what makes it so great, right? Boring businesses.
Boring businesses, but everyone needs
Boring
them.
businesses.
Everyone has them
That's
in their
right.
place.
Boring, essential, and here to stay, right?
That's right.
Yeah, I love it. I love it. Um, I've certainly learned a lot, Nicole. Are there anything else that you want to share with the audience in regards to, um, you know, specific industry insights or insights about Mac Capital that you want them to know about?
Um, I would say, if you are going to look into commercial real estate, that you really need to understand the tenant and lease structure.
Okay.
Um, and you got to know what drives demand, right? So, uh,
Hmm.
the industrial space as a whole is driven by macroeconomic trends. So whether we're doing U.S. manufacturing, but there's things like e-commerce growth has been one of the contributors to the growth of industrial. There's, like the reshoring or onshoring of manufacturing has contributed. The supply chain optimization or there's a whole bunch of very you got to know your why and what brings you in. And if you're going for logistics or data centers or manufacturing or storage, like um you got to be looking at the macroeconomics
Yeah.
because that is the key driver of this entire space. And you also really want to know your sponsor if you're not going to do it alone. And so, what MAG offers is we're a syndicator, which means, we have thousands of investors who come to us as a sponsor. We partner with them essentially. That's why there our LPs, right? So we're the
Mhm.
GP, they're the LP, they're solar partners.
Mhm.
And we do all the heavy lifting, and they get to benefit from the cash flow and the depreciation, and they get their time.
Yeah.
So right, so that is one of the key advantages of working with someone, and you really want to trust that person too.
Yeah, no, that sounds exciting. And that's why I was super ready to learn from you today. And if the audience wants to learn more on their end, right, what's the best way for them to get a hold of either you or Mac Capital?
They can find me on LinkedIn with my name. It's Nicole Daeila. My last name has a lot of vowels, but it's very unique, so you'll be able to find me. And then for MAG, you can always go on our website. That's www.magcp.com, and fill out a form, and someone on the capital markets team, maybe myself, would reach out to you, and we can have a conversation.
I love it. I love it. And I know that we are slated to actually co-host an event together later this fall. So I'm super excited about that partnership and looking forward to bringing you on one more time so we can talk about three critical teaching points that you want to share with the audience. Until then, Nicole, it's always a pleasure. Thank you so much again for being a guest, and I hope you have a fantastic day.
Thanks, Philip. Hope to chat soon. Bye.
Absolutely. Thanks. Take care.